Okay, everyone, welcome to today's webinar. My name is David Easthope. I'm the head of our FinTech Research group within Coalition Greenwich. I work in the market structure and technology practice, and I'm very pleased to be welcoming Shawn Douglas, CEO and co-founder of Amberdata, to our webinar today, entitled The Data Powering Digital Asset Markets. So welcome, Shawn. How are you?
I'm doing great. Thank you very much, David. It's a pleasure to be here.
Excited to have you here, excited to be walking through the ins and outs of the digital asset markets, and particularly we'll be focusing on data and data infrastructure. Before we jump into that, just some quick housekeeping. This webinar is around 40 to 45 minutes. If you do have questions, we will be interested in entertaining those. Please go ahead and drop those questions in the chat. We'll probably get to more of the Q&A towards the end of the webinar. Also, this webinar is being recorded, so if you are unable to listen for the whole session, we will re-release it in the coming weeks, so you can also share it with some of your colleagues. So with that housekeeping stuff out of the way, once again, it's great to have you, Shawn. I'm very excited to talk to you about digital assets data. And before we sort of launch into that, I'm always interested in how people got into this space. And you in particular have had a long career focusing on investing in technology, being a CTO, an engineer. Presumably you looked at lots of technologies over the years. So what got you into blockchain broadly and then digital assets more specifically? What piqued your interest?
Yeah. How did I end up down this rabbit hole?
Exactly.
It's funny is I've been a technologist, I've been a derivatives trader, I've been a venture investor throughout my career. And through the common thread against those seemingly very different paths is you've got to be, trend spotting, maintaining a technological edge, and taking calculated risks is really who I am and who I've turned into. Let's say that. I don't think anybody starts out with who they are. It's kind of where you end, the path that gets you there, right? And I got exposed to Bitcoin mining pretty early. It's like 2012 when Bitcoin was $13 a Bitcoin. And then which opened my mind and dragged me down to the rabbit of, what is money? And I did some early mining in like 2014. I paid like 13.39 Bitcoin for each of two of the very first ASIC miners, which is a lot of money today. And mined about 200, and that was when Bitcoin was like $300, and I mined about 200 Bitcoin over a period of time, lost half of it from being stolen, and didn't hold on long enough to a lot of the others. But it really opened my mind and is some concepts of early Bitcoin enthusiasts was, and it may sound funny, but what is freedom? What is liberty? And it's being free within a society and being able to mitigate oppressive restrictions and having a government or an institution impose an authority on the way you live, the way you behave, on your political views. And Bitcoin kind of felt like was the red pill to that. And then, coming out of the great financial crisis, there was also, trust in institutions and trust in public sector had eroded, and people have been grasping since then for a solution for fair and transparent alternatives. And, early on, I recognized that digital assets were really just a continuation of the digital transformation trend that my entire career has been built around. Going from paper to computers is going from, personal bank accounts and products from one company to a global platform that with every person on the planet having access to a cell phone, having access to unbridled information from the internet. This is just the rails for new products and new financial services, and digital assets is going to enable things like machine-to-machine commerce and financial inclusion. And that's when I realized that digital assets is just really the future of financial services, and this future of finance is the future of the internet. This is the underlying core technology that kind of encompasses all the things I was interested in: technology and money and how do you create value for a lot of people at scale? So that's how I got into it, and by a little
Yeah.
oversharing, but I think it's an interesting story.
No, it's an interesting story, and I definitely feel that too. I feel that you mentioned that like continuous wave of
Yeah,
digital transformation and adoption. It definitely feels like the next wave, the next element of that sort of long journey. And I felt similar, almost pressure even beginning of my career is like showing up at a Wall Street institution, doing equity research, saying, who knows about tech? It's basically all fintech all the time, right? And this was in the
right.
late 90s. So similar experience with that. Obviously one of the things from our perch here at Coalition Greenwich is we get to be independent. We don't have a dog in the hunt, as they say, and which allows us to conduct research on the space and really understand how institutions are implementing these assets. So definitely want to mention here that we collaborated with you, we partnered with you on a very interesting industry study that we conducted in May and June of this year, and it's been released publicly. We'll be sure to share that link with you all on the webinar, either in the chat or in the email follow-up, so you'll have access to that. And thank you for just posting that. So I think that the key here is that more and more institutions are coming, and definitely some great nuggets from that research that we did together. But one thing I wanted just to take a step back on is what do you personally see, Shawn, as like the biggest challenge for adoption by institutions?
Yeah.
You've talked a lot about the late majority of institutions coming in. What do you think is the biggest challenge?
Yeah, so I think the early adopters are already in. You're already seeing thought leaders in TradFi and crypto, and even enterprise software and enterprise applications. You're seeing early adopters and thought leaders making the move. It's that late majority, or even the early majority that's starting to move now. And I think if you think, and I'm trying to like pull this back, and digital assets is not different really than many other technologies. There's a barrier, and from a technology perspective, institutions today run on legacy systems, and they've made prior investments and created technology moats that are sunken costs, and change is hard. And look, some financial institutions run on mainframes today. Like my entire adult career, I haven't used a mainframe, but some of the biggest financial institutions in the world still run on mainframes. So moving away from legacy moats that have been significant investment and change in processes and adapting to modern technology, there has to be a catalyst that says my business is at risk, or I'm going to have order of magnitude changes in my performance of my business as that forcing function. And that's why it's hard to drive change in companies that are profitable and have built successful moats and models. So I really think that adapting that new technology, this is complex. This is not, I run an exchange and I own the exchange and everything is there in my little world, in my database, and I just have customers connecting to my database, because that's what today stock markets are. This is a global network of intermediaries and participants transacting around the world, around the clock, in different jurisdictions, in different regions, and it's fungible and it's real time. And there's a big, oh my God, I need to get my head around this. So there's a lot of technological complexity. There's a complete paradigm shift in thinking and what they can control and what they can influence. There has to be changes in the processes in their businesses, and the understanding, that incorporating that into institutional learning, so that I can create new products built upon this infrastructure, that it either opens my total addressable market to every person on the planet, or it allows me to create new financial products in a more efficient, more effective way. And then once I understand the tech, I understand how I have to change my process, and I understand the institutional learning that I have to educate. Here's the rules by which you must operate by, so we can build a sustainable long-term business. Then there's the regulatory question. And, like, can I do this? And can I do this how, where? And there's different rules in different regions. And I think as painful as it's been over the last 2 years from a regulatory perspective, I really think that the green shoots are growing and it's very healthy. And we're really on the cusp of tidal change being enabled by regulatory clarity. And I'm actually very excited about it.
Absolutely. And we'll probably get to that. That sort of, I almost think of it as subterranean optimism about the US market structure, right? If
Yeah.
you look out far enough, but it's there. And if you have those conversations with people, maybe it's not in the public consciousness or in the everyday conversations, but it's still there.
Mhm.
So we'll definitely get to that. And before we kind of dig into some of the research and insights we had, I should probably ask you just to kind of define Amberdata's role in your business, because obviously you are enabling many of these institutions to get into the space. I think of you as helping to extract the value of data. Some of it's already out there for these institutions. Maybe just kind of briefly introduce Amberdata and the business into this discussion before we kind of talk about what institutions are doing.
Yeah,
Should have
absolutely,
asked you.
absolutely. So, yeah, no problem. So Amberdata is the leading provider of institutional digital assets, data, and market intelligence. So what does that mean? That means that we are the connectivity that allows somebody to have visibility into what's happening on every spot market, every derivatives market, every options venue. On chain, think of that data as these are global networks that allow people to create products and services, and that part of that is you need to account for who held what, when, at what price. Secondly, there's underlying fundamentals that are embedded in the crypto economic mechanisms that run these protocols. It's just like I get my quarterly report when I buy Amazon stock, and I'm going to do something based upon that quarterly earnings. This, you get real-time data of the economics of these protocols or the networks or the behavioral economics online. So we encapsulate all of that into a unified platform and API, which enables institutions and participants in digital assets to accelerate their time to market, build on top of us, across the whole value chain, front office, mid office, back office, auditors and regulators. So they all have the same view of what's happening in the world.
Yeah, I definitely see that. So those, we'll use the term enabler loosely. I think, very much Amberdata sits as an enabler for this space. But, one thing that's somewhat overlooked, I think, is the people. And, one of the things that we found from our research, which was, quite interesting, is that more and more asset managers, more and more hedge funds are putting senior people in dedicated roles and giving this responsibility and accountability on, okay, how do we deal with and benefit from digital assets? How do we build products? How do we trade? And they see this clear market opportunity in the longer term, some in the short run and medium term, but others in the long term. So kind of thinking about those people sitting in those new seats, right? Head of digital assets, head of strategy, whatever they are, what do those people need to be successful in their roles? How do they maybe get beyond just data technology? What else do they need?
Yeah. So it's interesting. It's like it's a massive opportunity, and as such, it always attracts the brightest people who are willing to invest the time to learn. So first, they need to learn, right? And they need to understand, hey, wait a second, this all looks like TradFi. Because a lot of it does look like TradFi, and that's okay. So coming to this space with deep industry knowledge about financial services, financial products, etc., they have an edge. But it's the digital natives and the people who are investing the time to learn that are seeing this opportunity. So first thing is they have to just roll up their sleeves and they have to learn, right? And that's enabling this changing of the guard for the people that used to run the institutional infrastructure to the people that are building the future of financial services. And really, that's a paradigm shift that's happening today. And I think really that started like 2 years ago. And what do they need? Any business, any financial business, you need to be more data driven than ever before. And that isn't changing. If you think about large language models, if you think about quantitative trading, if you think about behavioral economics, all of those are data intensive. And obviously, I'm a data guy, so to me, that's what you need, right? But their ability to identify opportunities and quantify risk and to act upon that, and then a lot of these people, you don't have all day. You need to seize that opportunity, and you need to work with partners that are going to accelerate your time to market so you can seize that opportunity. And that's really where we come in. And I think so. Just in summary, I think you need a change of mindset. You have people willing to learn. You have to have the data to inform your decisions, and then you need to act. And what we're seeing, and I think your research was amazing, is what's it, 25% of all of the asset managers today, that's a huge number, are aware and acknowledging and moving towards this. And with not just crypto, but you also have a lot of the major banks, whether Standard Charter or Citi or Goldman or JP Morgan or DBS, or they're working on tokenization of real world assets now. You're seeing Project Guardian out of Singapore as a financial DeFi sandboxing across these multi-bank consortium networks. To me, that's a huge indicator for every asset manager that this is not some pipe dream. This is happening right now. And so I think that makes sense why you're seeing 25% of the asset managers surveyed have a horse in the race.
Yeah, you've mentioned it being recent, but feeling very real and very tangible. I think that's what's different now is, I mean, you see these people at conferences, you see that their title has changed, or they have a new business card, they have a new, org chart, and it includes digital assets. And as you mentioned, 25% of managers and hedge funds today, but increasing to 37% over the next 12 months. So I think they all see that opportunity. They all know that they have to organize themselves against that opportunity. As you mentioned, they need data, they need tools. They also need, there's a cultural shift as well that has to take place. And you mentioned the banks too. I mean, absolutely, we see that. I mean, the banks are on, the service providers that are on their own journey. And you've mentioned Project Guardian. That was something, Project Canton, some of these avalanche subnets that are being created. Like there's a lot of experimentation and definitely a lot of gradations of public and permission blockchains out there. But I do want to kind of, you've hit on regulation twice already, and it's absolutely paramount to this discussion, particularly where we sit here in the US. We've kind of talked about the research a couple of times already. And by the way, I'll just remind people that access to that report is available through the link in the chat. You'll also be able to find that on Amberdata's site after the event. But one of the things that also really resonated was this view of regulatory frameworks. And despite all the discussion about Dubai and Singapore, we've just talked about Singapore, Dubai, the US is still plugging along. And for those folks that are here that have legal entities and homes and Bloomberg terminals, and they pay their bills here in the US, they want to see the US succeed. And so, what do you think what is it about the US that it continues to do well, or people seem to really hold out a strong view of the market structure, despite some of the current climate that we see? What do you think what can you attribute that to?
I think there's a bunch of things there. I think prior to everything that's happened in the last year and a half in crypto, with all the frauds and counterparty risks that's real, right? Those have an impact on the collective psyche, and regulators have to respond to that. And there's some sharp elbows, I think, but at the end of the day, there's a couple things going on. I think you got to pull this question apart. First and foremost, culturally, the United States is one of the most entrepreneurial, optimistic, free market places on the planet. And we're going to figure this out. We will find our way. The regulators will do the right thing. It'll just take, they need to digest the bad stuff that's happened, that was really bad stuff that could have happened in any business, and had nothing to do with digital assets per se. It was bad stuff, bad people doing bad stuff. That's going to get sorted out. And I think that everybody I talk to believes, and I believe, there's a path forward. Now, the cool part is, while the US has been going through this last year and a half or so of challenge, you've had massive advancements in Hong Kong being open for business. You've had Singapore being a major proponent. You have MICA come out in Europe. You have VARA come out in Dubai. You have ADGM coming out with clear regulations. You have London coming out. You have France. They're like, everybody's open for business. And I think that puts more positive pressure to drive towards regulatory clarity. And what's so amazing to me, as we talk to the largest banks, the largest exchanges, the largest market makers, the largest funds, the auditors, the regulators, they're all our customers. And I don't see anybody slowing down. And what I see is all of the traditional players actually continuing to invest, knowing that there's a path forward in the United States and knowing that there will be clarity, and they're building. And I'm seeing the green shoots now where those investments are starting to materialize into serious changes in the infrastructure. So I think it's healthy. It's just a tough macroeconomic environment that, and some bad things happened that kind of gave us this feeling like it was not okay here, but I think it is.
Yeah.
There's the US optimism coming out.
Yeah, no, absolutely. And you can feel it. I mean, if you talk to enough people, as you mentioned, there's a lot of focus on the headlines. And I like what you described as kind of digesting, some of the bad stuff. And that does take time.
Mm-hmm.
And you mentioned, yeah, I mean, banks don't make investments over quarters. Like it's over multiple quarters, multiple years. So some of these things that have been brewing are starting to come online. We're definitely seeing the tokenization discussion really reach strong levels, that I haven't seen before. And that's happening around the globe, tokenizing, not just bonds, but money market funds, VC, private equity, you name it. And those discussions obviously take a while. So it's not just the managers and people building products and trading. It's the sell side as well. And I think this increasingly debate is now happening, as we mentioned, about what's truly DeFi, what's permission, what's permissionless, and all the gradations in between. It kind of reminds you of the whole internet versus intranet discussion we've been having
exactly.
for a long time.
Right.
But definitely, I want to mention that kind of bank discussion is very, very prevalent and fascinating, to be honest with you. I think as an enabler, as a builder, right? And clearly people are continuing to build. One of the elements that I think that in our research kind of blazed a trail on is like, it's not just custody, it's all of the data infrastructure and tools. And I think you've kind of talked about like the full value chain, right? From trading to investing to managing portfolios to managing accounting, tax, risk, all those things. And I think that's a key part of this tech, build. But one of the things that certainly I want to emphasize is kind of the data side, because all of our research shows that there's massive amounts of spending on market data across multiple asset classes, equities, fixed income, and now crypto as well. And whereas in the past, I think the crypto data discussions has been around some of these analytics firms, the risk firms like Chainalysis and TRM and Elliptic, now is shifting more towards, you mentioned, how do I get market data? How do I get DeFi data? How do I get this blockchain data for people who are used to getting that from Refinitiv and Bloomberg, right? So, first of all, do you agree with that kind of that scenario of like where we are now? And then secondly, what differentiates Amberdata and firms that are maybe more of the specialized providers versus the aggregators, in that sector?
There's a lot there in that question, David. In fact, I actually agree with how you framed the whole thing. Is that okay? So first, let me unpack a bunch of stuff there. So, the banks who are leaning in today, they're doing this real world assets. What is that? It's effectively securitization, if you will, and it's the packaging of illiquid products to make them more efficient, more effective, more transparent, so they can move off of legacy systems and enable visibility, transparency across their counterparties. That's all a data problem to me, right? So like that's happening, right? And then to operate in digital assets and to do so safely, because they are bearer assets, or at least most coins and DeFi tokens are bearer assets, meaning if you hold it, you own it, and you can show lineage and you can trace it. But once it's in your hands, it's in your hands, right? So early on in the industry, you figure, the last digital assets has been around for 10 years. Really, over the last 2 to 3 years, you've seen this explosion of other use cases than Bitcoin. And the first fundamental thing that needed to get sorted out, and you saw this is where the early unicorns were built, is how do I store this stuff and not lose it? Like, you're looking at a guy that's had, probably 100 Bitcoin that I've lost. You're like, that's a lot of money. You can't do that, right? As a business, for this to be viable, you can't lose it. So therefore, early enablers were custody. Today, custody is still not solved for institutions. There's lots of variants. Lots of people are doing great stuff. You see a lot of the international banks. I think really banks are best positioned to do custody, because custody is really not a technology problem. It's a process access management. So you're seeing the early unicorns in digital assets were, first, how do I store this stuff? Because everybody needs to store it and you're afraid of losing it. So therefore, then the second piece was, how do I do transactions on a global network with pseudonymity, where I'm not sure who the other party is, and not go afoul of OFAC regulations or treasury rules? So people like Chainalysis and Michael over there, they saw that early. And they were really, you could not operate in digital assets or crypto without first knowing, is there a KYC? Is there AML? Is there a bad guy on the other side of this? Or if somebody stole my stuff, how do I find it? So they were really, in order to operate, you needed to have Chainalysis in, as an on-ramp. The first thing is, how do I store it? Second thing is, how do I not get stuff from bad people or not get stuff stolen or go to jail, right? So now what we're seeing is custody is well known, and the KYC AML is well known, and like you called out, Chainalysis and TRM, of and maybe Elliptic or what have you, are the leaders in that space. There's few. Now that those kind of early problems are solved, now people are like, how do I identify the opportunities? How do I quantify risk? How do I understand my counterparties? How do I build a business? How do I count? How do I report? All of those things are data problems. And Amberdata, we're going to be the next $100 billion company, the next unicorn in this space, because we're providing that core infrastructure to create and protect value. It is no longer about, where do I store this, or how do I not take the bad guy's money or have my stuff stolen. This is about, how do I build a sustainable long-term core business around that. And did I cover all your questions there?
Yeah, no, it did, because I think that
Yeah.
I like the way you kind of think about it, kind of the from the bottoms up, right? From custody. Now you want to transact. Now you got to make sure you're not dealing with nefarious entities, that you're following the rules and regs. But I also think at the same time, there's probably a little misconception in the industry that all this data is public and it's really easy to get, right? So what is a data provider? How do you differentiate, right? So I know that people may be surprised. It's like some 30 plus exchanges, some 6 to 7, derivatives exchanges that matter, 24/7 markets. Like, you've talked in the past about getting the reference price. Like, this is not trivial, right? Security master. So maybe we can talk a little bit about, like, what's different about this space from a data perspective that has made it more difficult from traditional data aggregators to maybe solve for it, at least initially, right?
Yeah, so I think there's a complexity problem, there's a cost problem, and then there's a learning curve. And those there could cost a firm 3 to 5 years and $5 to $15 million in infrastructure spend too. Because you think about it, like, this is more like FX than it is like equities. Because like equities, like, okay, I connect to New York Stock Exchange, I connect to NASDAQ, I see all the equities. Boom, boom, done. Right? But like with FX, there's how many banks that trade FX around the world, and half are in London or whatever, right? And you really need to have high fidelity, high frequency connectivity to the exchanges, and have the integrity in your operational processes and the monitoring and the support to ensure that you got it right. And you did it right, not on one exchange, but on all the exchanges you support, because these assets may have locality of price. The price in, Seoul may be different than the price in London for a reason, for a period of time. They will converge because there's a spot market generally, but there's these locality of prices matter. So you need to have that connectivity. Now, on the blockchain data, yeah, it's all totally public. Anybody can connect and run a node that wants to spend, $30,000 a year or whatever, $60,000 a year to run a blockchain node. But the raw blockchain data is completely useless if you do not interpret it and parse it. Because you think of a blockchain, it's like a database, an application server, a currency, and an incentivized token system, or incentivized economic system that is all transparent. But you need to be able to decompose and make that turn that raw data into actionable information that is right. And that is actually incredibly hard. Not only do you have to spend, we've spent tens and tens of millions of dollars of infrastructure investment and have SOC 1 and SOC 2 and all kinds of, infrastructure. It's incredibly complex. It's expensive. It takes time. You have to be able to hire the right people to do it. If somebody wants to get into digital assets, they don't care about any of this stuff. They're like, I just want to build my business on X. So now, how are we different than other players? Is we started in 2017. When we started doing this, there were point retail solutions for price, super retail. There were nobody that did blockchain data the way that we did. It was Etherscan. They've been the pioneers in this space for a long time on, blockchain explorers, but they didn't do what we did back then. So we really early on recognized you have to have a comprehensive view of everything that's going on in the crypto economy to be able to make informed decisions and to be able to build data-driven businesses. The data's got to be right. It's got to be highly available, and it's got to be done institutional grade, which is not free. And, so it's about having the process and the discipline. And that my infrastructure cost is my moat. Nobody wants to spend that kind of cash and that kind of go through the pain of that learning curve today. And even the incumbents, the Bloombergs and the Refinitives of the world, have years and years to catch up to get this. And there's the smartest people in the world are looking at this, and we've been fortunate enough that our edge has been to work with them, and they're demanding and they have hard requirements we have to build, right? And then the other players in the space, most of them have point solutions. We compete with one company that's really good at market data. We'll see other people that they're node as a service, which means you have to do all that processing yourself. But there's really nobody that does institutional grade, comprehensive, that spans from blockchain all the way to, derivatives of all surfaces and skews on options. There's just nobody. So we really defined the category and have become the dominant player because we just been doing this for 6.5 years at this point and working with really demanding customers. That's our edge.
Yeah, and you've definitely hit on this theme of what's fit for purpose and what is really institutional grade. And I'm always arguing for custody, data, other solutions that truly serve the needs of those institutions. Mm-hmm. Because much, as you mentioned, much of this market structure was built for VC, family office, but individuals and even some corporates, right, like for buy, sell, hold, right? But not to have real-time portfolios and risk analytics. And now everything's being built for the much longer term, not just to get into the space, but to actually build and manage portfolios, right? And that to me really raises the bar for data providers such as yourselves.
Well, even to that point, like some of the rating agencies now, like Moody's did a report yesterday. They cited us in it on stable coins and stable coins flows, and S&P's done great work. And it's like it's getting to the point where the distinction between digital assets and anything it's just blurred, because guess what? It's just the next gen of the current gen.
You're right, because there's this element of like, oh, that's all public. It's all on the public
Yeah.
blockchain. And then there's this enterprise blockchain initiative. But if you look at those ends of the spectrum, there's a lot in between.
Yeah.
Like there's these subnets and there's, you can use public chains for KYC, AML, legal identity. Like you can do
Mhm.
all sorts of stuff, and it starts to get really blurry. So where is it like traditional finance? Where does that end, and where does decentralized finance begin? And I think there's gradations in between.
Yeah, totally.
You're absolutely right. I mean and you've also mentioned how even the regulators, right? They're armed with this data now. Like they need to have
Yeah.
you know they need to be understanding what's going on in space, if anything, just to observe, as opposed to necessarily doing anything at this point. But I do want to jump into this DeFi element, because I think that's where this is the point where some institutions sort of they lose the plot, right? They're like, okay, how do I jump from I build portfolios that hold these tokens. They're safely held. I've got data, reporting. I've got tax and accounting. Good, but now we move toward this not just settling on chain, but execution on chain and smart contracts. So it does feel like we're still in the early days. But maybe you could, maybe from your perspective, like where are we in DeFi, and do we have a good definition of that? And what will drive more institutions into decentralized finance, do you think?
Yeah. So I think DeFi is still early days. However, there's a massive amount of trading volume. And in fact, some of the decentralized exchanges like Uniswap have eclipsed Coinbase's spot trading volume. And even the TradFi banks, like I mentioned Product Guardian earlier today, and Product Guardian, the demo is that they have a DEX. And I think it's a fork of Uniswap, and they're facilitating, Singapore dollars to yen to tokenized bonds to structured products, and they're swapping them on a DEX. Like in a sandbox, it's early days, it's the future. But so I think that today DeFi really is composed of decentralized exchanges, that's a DEX, right? And where you facilitate trades on a price curve based upon assets in a pool. There's lending protocols, which things like Aave, Maker, Compound, where people generate, yield for loaning out their assets. Unlike loaning your assets to, BlockFi or Voyager or others that went out of business, these are actually, you can see the health of your assets, and they're dynamically liquidated, and they manage the risk built into the protocol. So there's no people involved per se. It's programmatically done. And I think that's a huge innovation from a transparency and trust perspective. And then there's, I would consider stable coins as part of DeFi. And you ask, well, what is a stable coin? A stable coin is similar to, say, the euro dollar, right? Where you're like, okay, these are dollars that are not backed by the Federal Reserve, but they're tokenized dollars. And if you look, Citi is doing this, and JP Morgan is doing this, and other people are doing this on their private permission networks. But the stable coins, the leading players being USDC or Tether or some other players, Paxos or what have you. What do? They back these stable coins by what? They go out and buy US Treasury bonds. That's how they generate this yield. There's no secret here. So it's actually, if you think about, that's a tokenization of real world asset, right? It's tokenized US dollars. And
Yeah.
it's today, those serve several things. One, it's seamless, instantaneous global settlement and payments. That's transformational in itself. And Ripple and USDC have built massive businesses, and they're just getting started. It's also, how do I generate an interest rate that I'm not getting in my bank account, that somehow the prime rate is a much higher than I'm getting in my interest in my bank account, but I can actually generate those yields from a stable coin. So they're like cash instruments, but I actually generate yield like a savings account, which is pretty interesting. And then there's the remittance use case, which is can't really be overlooked. In the US, we could just send money around pretty easily. But once you go cross border, it becomes incredibly difficult. And I think that, and then you start to get into, IoT and how do you do payments between different things? Well, stable coins preserve value, providing they maintain their peg, and they facilitate those transactions between programs. It's massive, right? So I really think they're a core part of DeFi.
Yeah.
And the killer
No,
use case.
absolutely. And I would just add, you really hit well the range of use cases across the various banks. One other one I'm hearing a lot about is for internal efficiency on collateral and, you know, being able to move assets around, and just that ledger that just kind of tracks asset movements is quite
Yeah.
useful for collateral repo, other
Repo
kind of
markets. Yeah.
yeah.
And even
Yeah,
the other thing that here too is what is it? The T+3 settlement that happens today with equities. Well, when that switches to T+1, well, how the heck do you move money from, say, Australia or Hong Kong to the United States to settle unless you have instantaneous payment rails? The whole existing payment rails are 50 years old. It's ridiculous.
I know there's a lot of FX traders sweating T+1, right? Because does it really mean, is it more like 8 hours or four? Like what number of hours do you really actually have to deliver, right? It's less than you think. But yeah, and I think you're hitting on the right kind of the next frontier is sort of like these cash and cash like instruments on chain, whether that be tokenized bank deposits, you know, you've mentioned stable coins, money market. Like, so if you're tokenizing all these traditional, you know, assets and real world assets, what about the P of DVP, right? What about the cash piece? And I think when you have that, then it starts to be much more of an actual replacement for what happens currently, as opposed to I think sometimes, you know, you've lived in California in the Bay Area, as have I. You know, you had to build the next Bay Bridge before you could tear the old one down, right? People forget you can't just build a right. So maybe there's this analogy of like, oh, you're building the next bridge, but you can't tear down the existing infrastructure and, you know, DTCC and CLS and all this stuff that had been around in Swift for years and years. You can't bypass that or leverage that infrastructure in a different way until you've built the new bridge and you can take the old bridge down. But I think part of that new world includes cash, right? And you've mentioned stablecoin adoption is so strong. If you look at the list of the top assets by capitalization, they're there. So you're absolutely right. I think sometimes that stablecoin piece is missed by many. And you know, people will focus on that long tail of those exotic assets, and they'll forget about the biggest asset, the US dollar or the euro or the yen. Yeah, I mean, just in the time that remains, I think maybe one final question would be, do you have any sort of crystal ball predictions on that, on kind of the cash leg? I know CBDCs are kind of the rage and discussion, but sometimes that feels a little too long term. But maybe just in closing, like, what are your thoughts on the future and the crystal ball on that element?
It's so hard because it's such a fast moving environment. And I think that we're out of this kind of ugly thing that's happened in the last year in half in crypto, right? And before it was like crypto, this, and you know, it was a lot of hypes. You're in this big hype cycle. Where I'm seeing now is people said, hey, this is digital assets, right? Now I'm not even hearing digital assets in conversations as much as this is the next generation financial services rails. And to me, it's like, I got that like 6 years ago. But I think, you know, my curse of life is I'm often right, but too early, and to recognize. But finally, I think it's really, really, we're seeing, you know, don't have to listen to me. Just go and look at every major bank and just look at what they're doing in digital assets, private blockchain or public. It doesn't matter. It's the exact same thing. It's like you said, internet versus internet. There will be no distinction in the future. Just like we've seen this play out before multiple times in our careers. I think that is where it's going. And the regulatory thing's a speed bump. It gets sorted out. It becomes the US, I hope, and I believe, will get this right, and it will have learned from everybody else, and we'll have the advantage to see what's working in other places. And we're going to come up with a very open, collaborative, you know, leading way of doing this. And The TAM on this, if you're not paying attention, whether you're in finance or you're in technology, you're doing yourself and your company a disservice. This is the biggest transition in parabolic opportunity I think I've seen in my career, because it combines a paradigm shift in financial services with a paradigm shift in technology, with a enabling of the every person on the planet from a financial inclusion and financial services perspective. It's literally just a continuation of the internet trend. It's so big. So like, drop what you're doing and go get smart and help us build this.
Yeah, that TAM is often mentioned. Yeah, multi-trillion. I think there's a recent research that just 10 trillion. But what you're describing as well is sort of, I always think about the parable of the elephant. People are all holding a different part of the elephant in the dark, and some of them see Bitcoin, or they see the blockchain, or they see Ripple, or they're thinking about tokenized bonds. But the big picture of the elephant is massive, right?
Yeah.
And so everyone, it's not exactly clear what it is, but we know it's, as you mentioned, it's big. It's something that people can't see the totality of, and that's kind of how I think about it. But this has been really great, and Shawn, thanks for your time, and we'll definitely we'll be posting this again so people can rewatch it. But once again, it was a pleasure to have Shawn, co-founder, CEO of Amberdata, give us perspectives, and thanks very much for joining us, and I'm looking forward to continuing discussions further. Thanks, Shawn.
Thank you, David. I really enjoyed it, and we love helping people on their journey, and please reach out to us. Thanks.
Please reach out, and please check out the research. Thanks, everyone.
Thank you.
Have a great day.